What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we're going to look at what Federal Reserve Chairman Jerome Powell said in today's announcement about the FOMC meeting that happens 8 times every year. And today they had a little press conference where they talked about what their decision was in regard to monetary policy from this meeting. So today we're going to go into some of the things that he spoke about, some of the things that he said, and look at the results that had on the market and what we might be able to expect moving forward. Let's dive in. All right, so the bottom line for this meeting is that they decided that they're going to continue to purchase assets. They're going to continue with these asset purchases. They're going to keep rates at zero for the foreseeable future. They're not going to go negative with interest rates, but they will keep them here at zero. And as always, he always says that they're going to continue to monitor incoming data to see if any changes are needed going forward. But ultimately, the conditions are bad enough still that they deserve the stimulus and asset purchases, low rates, everything that they're doing right now to continue trying to make the recovery happen. Now, immediately when the announcement came out, it pushed stocks up, it pushed gold and silver up, it pushed Bitcoin up, it pushed treasuries down, but junk bonds started to rally. And so we had some big market moves across the board right at the start, and then as Powell started to continue speaking and answering questions, some things started to reverse. Into the close, stocks were actually down, particularly small businesses. Looking at the Russell 2000 here, stocks were actually down. Gold and silver continued to rally. Bitcoin continued to rally. And then treasuries also started to rally after their initial sell-off. So Powell made a couple of very interesting statements here during his announcement, during his speech, and in the question and answer period that followed his speech. And so I'd like to zoom in on just a couple of those and tear them apart. Now, the first thing that Powell said that was kind of interesting was that when the time comes, they'll put these tools back in their toolbox. Now, if there's ever a sure sign that something is going to be permanent in politics, it's the usage of the word temporary. So the very fact that he's saying, hey, at some point we're going to put these tools back in our toolbox makes it seem like these are probably going to be around at least for a very long time. Pair that with the fact that it echoes some of the statements from past chairmen who have said, hey, at some point we're going to wind down our balance sheet. During the financial crisis, they said that the balance sheet would be under 1.5 trillion by 2012. Well, clearly that didn't happen. When they finally tried to start tapering down the balance sheet, it started to crush markets, and then they had to reverse course late 2018. The way that the Federal Reserve's monetary policy works is kind of like a ratchet. They can move forward, but it's almost impossible to move backwards. So anytime you open up Pandora's box and you let things out, it's like a tube of toothpaste. It's almost impossible to get that stuff back in. Now, another thing that Powell said is that he emphasized that they're lending programs, not spending programs, because spending programs are through Congress, through fiscal policy. Fiscal policy is done by the federal government through taxation or tax cuts. The federal government can spend, the Federal Reserve can lend. And so he wanted to emphasize these are lending programs, not spending programs, and we can only make loans to solvent institutions. By law, that's part of their limitations, that they have to have some reasonable expectation that they're not buying something that is, bankrupt debt. They're not buying something that's a toxic asset. Now, this kind of flies in the face of the common perception of what the Federal Reserve does. And in reality, they just use a technicality, a special loophole to kind of get around that. They use special purpose vehicles held at the Treasury in order to do this. And so they're not technically themselves buying this bad debt if it's something that looks like it's definitely going to be insolvent. And so they can do these bailouts and these purchases of toxic assets through special purpose vehicles and little technicalities and legal loopholes, and that way they can stick with their legal mandate. Now, another thing that Powell seemed like he really wanted to emphasize was that they are committed to reducing inequality, especially in light of the protests and riots that are happening all across the nation right now, and in light of the coronavirus and how it has disproportionately impacted the poor and the lower income citizens across our country. And so he really wanted to emphasize, hey, we're doing what we can to alleviate inequality and help out working class families, help out low income households. The only problem with this is that the Federal Reserve's monetary policies, their monetary expansionary, inflationary policies that debase the currency and make the purchasing power of money go down over time, those are the things that more than anything directly contribute to inequality. And so he's like Two-Face. Again, they probably just don't realize it. The Federal Reserve is, they're up in their ivory tower. They get paid hundreds of thousands of dollars per year. They're outside of the business cycle. Their benefits and their pensions, their 401ks, their salaries, their compensation, everything is completely outside of the business world, unaffected by what is happening all around the country. And so they're probably just so detached that they don't even realize that what they're saying is completely contrary to reality. But in reality, ever since the federal government has had the ability to spend as much money they want, funded by the Federal Reserve's printing of money, inequality has skyrocketed in this country. By any metric, whether it's wealth or income, the source of all of the problems of inequality somehow always find their way back to monetary policy. And it's pretty simple. It's because the people who are poor, when cost of living goes up, it's going to hurt the people who are poor and barely making ends meet more than it's going to hurt the person who's rich. In addition to that, when inflation happens, when monetary inflation happens, when they print money, that hits asset prices first. And who does that benefit? The people who hold assets. Who hold assets? Not the poor, it's the rich. And so monetary policy, by and large, for the last 50 years, has benefited the wealthy and disproportionately hurt the poor. Another aspect of how low rates and the monetary policy that they're pursuing right now disproportionately helps the wealthy and hurts the poor is something as simple as loans and debt like credit cards. Credit cards are the only form of debt that most poor people have access to. Have you checked what credit card companies are doing recently? They're raising interest rates. They're actively reducing available credit lines. They're demanding new, fresh proof of income from people to keep their credit lines open or the same. They're closing accounts, and they're demanding higher credit scores in order to open up new accounts. And so to access credit, it's getting more expensive and harder for the average poor person. At the same time, as large institutions and the ultra wealthy have access to the really cheap, really easy debt. Again, more monetary policy that doesn't help the poor because the poor are subject to the market effects of tightening down when things get tough, but all the rich and the big institutions have access to all the easy credit, the easy money provided by monetary policy. Now, Powell also made a comment here which he kind of stuttered on and then tried to backtrack a little bit, and he was basically saying, hey, risk and failure and business closures, bankruptcy, business downturns, recessions, these are things that are, kind of part and parcel. They're kind of built into capitalism, and they're, it's the nature of capitalism. It's the nature of the beast. You have to allow these things. He said, but this is different. We're experiencing, we're facing a giant catastrophe that nobody planned for, nobody could have foreseen, which if you follow Nassim Taleb, you know that the coronavirus is actually, by definition, a white swan event, something that was virtually guaranteed to happen, not a black swan event, something that couldn't be predicted. But he says this is different, and so because it's so different, we're facing this, giant catastrophe. We have to step in, we have to save people who are, at risk of no fault of their own. That's capitalism. Capitalism is risk for everyone. It's every individual, every business, and every person has the risk at all times of losing their place in the wealth hierarchy or losing their money or placing a bad bet. And anytime you allow for a safety net, you transfer the risk from that one person who had the risk to the entire system. And there's a real cost for this. You're actually socializing the losses. So it's basically like you're saying, hey, there's risk and failure is something built into the capitalism, but right now we're facing a lot of risk and failure, so we need socialism. That's not capitalism then. That's just socialism. I use this analogy a lot. It's like there's a bunch of people standing next to a cliff. And if you push one person hard enough, that one person will probably fall off the cliff. But then once that one person falls off the cliff, everybody's going to look around. They're going to be like, I need to get further away from the cliff so that if somebody pushes me, I don't fall. And so the entire system gets stronger when every individual has individual risk. Now contrast that with a system where everybody's standing next to a cliff and you give them all a rope and everybody is, tied to the same rope. Well, you push one person, the rest of the group is going to be strong enough overall to prevent that one person from falling over, right? But if you give them a strong enough push and a couple of them fall, they're going to pull everybody down with them. So when you have individual risk, it makes the system stronger. When you have risk transferred from individuals to the entire system, it makes the entire system fragile to collapse. Now, Powell also mentioned that they're, really trying to gear for inflation. They're really trying to help things out and pump money into the economy. And they're just kind of flabbergasted because they're like, yeah, there's no inflation anywhere we look. Have you seen the stock market recently, Powell? Yeah, the S&P 500 is up 50% in the last 2.5 months, but there's no inflation anywhere. Asset price inflation is price inflation. It's just not consumer goods price inflation. It's asset price inflation. It's still inflation. When you dump money into a system, it's got to go somewhere. We can clearly see where it's ending up right now. And it's only a matter of time before that bleeds over into the rest of the economy and starts hitting prices of goods and services. So 2 more comments he made that I'd like to touch on. This first one here, it's pretty funny because he's so close to the truth here. Again, he started talking about inequality again because one of the reporters continued to ask him, pressed him a little bit on inequality. And he said, number 1, inequality is not related to monetary policy whatsoever. Number 2, he said, there are some theories as to what causes inequality. But number 3, nobody really knows exactly what causes it. And then 4, this was the funniest part. He said, inequality, by and large, has been increasing for over 4 decades now. Yeah, I guess Powell doesn't remember what massive change happened to monetary and fiscal policy just a little over 4 decades ago. If you have about 5 minutes, visit WTFHappenedIn1971.com. I've done videos about all of the charts on this website before, but it will really put things into perspective for you. Just over 4 decades ago, back in 1971, when the dollar was freed from being constrained by any backing to gold, and the government had the ability to spend as much money as they wanted and just print the money to pay for it, that's when you start to see inequality skyrocket. And the important part is the trend was going in the opposite direction before that. Sound money helps the poor, helps the lower income families disproportionately compared to wealthy people. And the opposite is true as well. Inflation and fiat money systems help the wealthy and hurt the poor. And finally, Powell said, one of his closing remarks was, he said, look, we're not really, because he was asked a question about, creating bubbles like in assets, like in the stock market right now, when valuations are literally, it's crazy how expensive stocks are when considering any traditional valuation metric. And he said, look, we're not concerned about moving asset prices in any general direction, up or down. We're not really looking at asset prices as a measure or gauge on what we should be doing. We're just concerned about markets functioning. Well, I guess functioning means going up, because clearly everything that they've done, even all the way back through the beginning of 2019, when, at the end of 2018, when they reversed course, started lowering rates again. Then last year they started doing QE. They started bailing out hedge funds and financial institutions through the repo market when the repo rate spiked. There were tons of things that starting to happen that would potentially crater asset prices due to markets that are not functioning. And so I guess functioning means going up. So looking forward, we can expect more of the same. Anytime you start to see tensions or ruptures in financial markets or asset classes, you're going to see somehow the Fed is going to step in with some more stimulus, or maybe the federal government will step in with more directed spending that is funded by the Federal Reserve. That was something Powell mentioned a lot. He said we really, he was hinting at it a lot, but he was really hinting strongly that he wants a lot more coordination between the Fed and Congress for more fiscal policy and more fiscal stimulus versus what they're doing right now, which is just monetary stimulus. So that's it. At best, what Powell said was naive and ignorant of the facts, and at worst, it was outright deceptive of the way that reality works. But ultimately, when making investing decisions, you, like anybody else, can see, hey, look, this means that it looks like asset prices should continue to go up from here, despite what the fundamentals of the economy say. Thank you so much for watching. If you enjoyed the video, please hit that like and subscribe button. It really helps out the channel. You guys are the best. Have a great day.